do you need? How do you need it? What would be the impact of its investments? And then we have seen the last session how you show all of these. The last part is the investment proposition. How do you show it? How do you show it? But to show those things we have seen last time, you need to prepare them. And to prepare them, you need at least these two tools. To have these two tools, actually, there is some work to do before assessing your market, for example, keeping your KPIs, keeping some track record, recording your activities, etc., etc., etc. But what we will be seeing today is, once you have all these things that are not really finance related but will impact your finance, how do you use them actually to convince your investor? So we will start with the first one, the management accounts. What is it exactly? I'm sure most of you maybe heard about it. So we'll have a first quiz, just to check if everyone here is comfortable with management accounts or not really. So Jenny, I don't know if you can help me on the the first quiz.
It's coming up now.
Yes.
You see it?
Yes.
Perfect.
So for the one that are here, just please try to answer quickly. We want. Okay. Okay. Maybe one more. Okay, maybe we have all the agents here. So three you don't know, and one you know what is it about. So thank you, Jenny. So interesting because you looks like the majority, you don't know what is it about. So I will try to explain it. It's one of the, for me, it's one of the tools I really enjoy using, because it gives me a lot of information on many things. So I will try to show you what is it about. I spent a bit of time on it, and then please, if you have questions, write them on the chat box, and then I will try to answer them. So quickly, just a quick definition. This definition, you can find it everywhere on internet. I took it on business dictionary. You can go there and see what is it about. It's just a set of data you have, you can use for your day-to-day management, day-to-day activity. And quickly we will see how you build them. The first objective of this is to manage your business, is to manage, for the entrepreneur, is to manage the business. But having those information could actually be very useful when you are raising funds. But also, if you have a board of directors, you will be doing some, maybe weekly, maybe monthly, maybe quarterly reports. And when you have these set of data ready, it makes it easy to have those reports. And for sure, once you have a investment, or the business has an investment, they will need to set up a board of directors, and then they will need to send some reports, like at least quarterly, but sometimes monthly. And having it will make really the process very easy. So the objectives are how you measure your past performances, and in order to improve your future ones, how you are going to manage your day-to-day cash flows, right? Again, cash flow management is the second reason why companies failed, really. So it's really important to really well manage your cash flows, and also to provide information on where to focus to improve profitability. Having this help you to see where exactly I am performing good, where I am not performing good, and then how I'm able to improve what I'm doing. You can who can develop this? You can download some. The example I'll be showing you is an example I have downloaded on internet, just to show you that you can find some on internet, some for free, some that are really well done, like the one I will show you. You will pay a bit, or you can just hire a financial professional to help you to create them. You can have very basic ones, and you can have very complex ones. What is important is to capture the information you really want to capture. Also, you can do it yourself, because they are not really complicated to do, but you have to be very familiar with Excel and a bit of some finance concepts. Some finance concepts like these financial statements, the income statement, the balance sheet, and the cash flow statements. But I will show you. I will show you right away how to have this. So what I am going to do is I will stop sharing this, and then I will share the example of management accounts. So do you see my screen? Hopefully you see the screen.
Yes, we can see it.
Yes. So let me just do this. Yes. So the first step on building your management is to list all the items that impact your balance sheet or your income statements. Here you can see some list, and then here you see the class, meaning it's B means balance sheet, here BS balance sheet. You will see IS income statement. And you see on the balance sheet you have, if you have some land, some buildings, cost, furniture, office equipment, these are things you buy or you bought that are in your balance sheet, okay? Some assets, right? The depreciations of those assets, goodwill, if you have some software, investments, etc. All these things are in your balance sheet, the shareholder contributions, and then you start having things on your income statements. The sales here, for example, it's an example of a company that's selling juice, but you can sell anything. So your sales, you have your sales here. You have the cost of the sales, right? Vegetables, direct costs of this thing. You have, for example, your accounting fees. You have the advertisement, your bank charge, commissions, computer expenses, office expenses. You have roughly everything here, all your expenses, your revenues, your assets, your dividends, for example, you have them here, etc. Everything that you if it can be expense, investment, revenue, equity, debt, whatever you have that is creating inflow or outflow of money, you have to have them here, right? Once you have them here, everything is easy. What are we doing is we have the same list here. Let me again zoom a bit. See, you have the same list here, and for each of these, you for every month, you write the I mean what it costs, or the revenue, or the the number right here. For example, depreciation, it's minus something. Here, furniture, it's a cost, so 60. If we go on the income statements, the revenue, for example, here you see it's the sales here, and you see here the cost of selling it here. So this is the past, okay? So we suppose we are on February 2020. This is the past. This is what we have done so far, okay? And now, right now, the current year, what we are doing. So March, April, we have done it a year, month on a monthly base, but you can have it quarterly. But really, it's important to have really the details, not by year, because if you have it in years, it's very difficult to monitor. This is today, and then the forecast. because when you are raising money, you have some forecasts. Let me zoom a bit here. Again, the same list, and here we have the forecast for the rest of the year till from February, so March till next February. Okay, 1 year forecast, monthly based, right? Once we have this, everything to have this, it's really easy, right? So these informations are available, and it's really easy to record. So once you have this, that's where we start really having some good information here. So again, here it's the income statement. You see the turnover, cost of sales, etc. The turnover here, it's the sum of all the sales, right? So the sales I am having here. Here we say forecast. This is the forecast here. So I will go on forecast, and if I do the sum of the turnovers, it are the sales. These income statement, on the income statement, here I have this cost of sales, the same thing. So I have a gross profit, which is the difference between both, etc. And I start building. Here you see all the expenses here, and I start building my income statement, and I have my profit here for the period, etc. So this is the forecast, for the year. This is what I have done. Okay, this is the difference. So I'm doing good or not in terms of percentage. And this is what I have done the year before to be able to compare. Okay, this is for the month, the current month. So here today we are in October 2020. We should have everything for this month here. So I know right now if in October 2020 I reach my forecast or not. Here I'm doing more than the forecast. You see, the difference is positive. And the last year I did much more. So meaning I'm good in my forecast, but I did less than what I've done the last year. And here you have the year to date, the year to date, meaning what I have done the whole year until today. Again, the forecast, the actual. So what I have done, I have done more than the forecast, and also I have done more than what I have done in the year, the 9 first months of last year. And here I see the difference, and I hear the difference here in terms of percentage. So you can see here, having these things, I'm comparing things here for this whole income statement. I am able to say where exactly I am doing good and where exactly I'm not doing good. If I see that there is a cost that is higher than what for example, here we can see that the cost of sales is higher actually than the forecast I have done. Well, which is not great, but I can explain. I will try to explain why. Here also you see the last year I have spent much more. So today I can say, oh, I'm comfortable because I have of course I have sold less, but also less cost. Meaning this month compared to the same month last year, I wasn't great. I'm not great actually. But if I compare to the whole year, meaning there are some months I'm good, some months I am not. But if I compare to the whole year, I'm seeing here that I've done a bit better. Okay, here I'm almost 3,900,000 in terms of revenue. Here I 1,800,000. Here I spent 1,600,000, so less, and I got less revenue, of course, 3,300,000. So this is what we call management accounts. So you can have I'm showing you a very simple example, but quite complete. I really like this example. But you can download some, or you can build some much more simple that capture what you want to really show, or a bit more complex. There are some that are very, very complex. more the business is big, more these management accounts are complex. But again, when you have a big business, it means you have people to manage those things. You have an accounting team, you have a finance team, etc. They will manage it. If you have a very small company, like the one maybe you are managing, you guys, maybe this type of things can be really enough. And so here I have done for the income statement, but I can do for the cash flow statements the same thing. The cash flow statements are built from some information from the income statements and information from the balance sheet, right? So these are formulas you can find really easy. The same format: forecast, actual, the difference, and what I have done last year. And see, I can see if I'm doing good or not, etc. And at the end, I really can see how my business is going, let's say even day by day, right? Because I have exactly what I have done so far this month, last year, etc. So this is a and also I can show you the balance sheet, you see, but the balance sheet is not really important to monitor day by day. What is really important are the cash flow statement. This is really important to know how I'm doing in terms of cash flow. The income statement is good to have, it's good to know, to adjust if I need to adjust. For example, if I see that I'm not doing great the whole year, and so I can see exactly where I'm not doing great, and then I can adjust if there is a need. So really important tool that really can help the entrepreneur to monitor everything, to adjust if there is some adjustment to do in a really day-to-day basis. This is a key tool, really important. So I will come back on the slides. So we have seen the example of management. So I have showed you a bit how do you create them. So to summarize, you list all the items that are in your income statement, that should be in your income statement and your balance sheet, really detailed items, you know, like here. Second, you generate in the past and today the revenues, the cost of each item. Again, the most difficult thing is to have this list. Actually, once you have the list, the rest for every month you generate the cost of what you have done in the past and today, and then you add your cost, the forecast, what you, because you did a budget every year. The company has to do, again, I'm not still yet talking about 3 years forecast or 4 years cost forecast that we will have in the financial model. Here it's just the budget. When every year the business start with, okay, this year this is what I want to do, this is the forecast, and then you say you have a budget saying, to do these revenues I have to have these costs, I will have this cost because, and then I budget this cost, saying today I have to spend 2 million, 3 million to reach 5 million revenue, 6 million revenue. And this forecast, that's what you will have here. Once you have done these three things, and then you start building the financial statements. The financial statements, income statements here, that's what I have showed you, you know. So I have everything here. And once you have this, actually, this is, at the end of the year, if you want to generate your financial statements, it makes it really easy. If you have an accountant, you send him this, he will do it very, very, very quickly, meaning you will spend less money and less time to generate your annual financial statements. And of course, it will cost you, it will cost the business less, because the accountant will spend much less time to generate them. So really important. And the second one here, the cash flow statement, which I found very, very useful, and one of the maybe the most important statement to monitor. Okay, so basically these are what we call management accounts. Again, you can have easy, very simple ones, you can have complex ones. If you go on the internet, you write management accounts templates, you will see many templates. So you can download some of them, just see how they work, etc. And if you need any help, of course, I will be here to answer some questions. But really, if you want to develop your own, you can do it. Maybe yourself, you can do it, or in your teams, if you have some people that are really familiar with Excel, they can do it really easy. So the second tool is the financial model, the financial modeling. Here, again, I think most of you already heard about financial modeling, financial model, knows what is it about. That's why I did not ask you the question, but just to summarize why we need them. We have four main objectives here to build those financial models. The first one is to show investors how you plan to make money. How I'm going to make money. I want to raise money, but how my business is going to generate money and then returns. Okay. The second aspect is how do you it is the translation of your business idea into numbers. A lot of people come and say, okay, in 3-5 years time, I would like to generate 10 million. Okay, but how are you going to generate those 10 million? I'm going to expand in this country. I'm going to generate to create a product, a new product, or I'm going to do this and this and this. All these ideas are good to say, okay, when you are in front of the investor, it's really important. But what they are looking for, how really you are going to make this? What would be the cost of each of these products? If you go in a new country, how much it will cost you? What do you need? Do you need to hire people there, or do you don't, or maybe you don't need the revenues you are generating? Maybe the first year you will be losing money, but the second year you will start making money, etc. These are what they are looking to, what they will be looking when you say translate your ideas into numbers. The third one is the scenario analysis, and I will give you an example. I will show you the what if question. You know, I will do 10 million. Okay, great. But if the pandemic, the COVID just show up, what is going to happen, right? Oh, I will decrease my sales by 10%. Okay, if you decrease your sales by 10% or 20%, what impact it will have in your profits? So in my money, I'm going to invest. These are what they'll be looking for, and also the cash planning. Again, cash is king. What, like a lot of people say, cash is very, very important. So this is where you will manage your cash, and we will see managing this cash. The ask, when we have seen in the last session that in your investment proposition, in the pitch deck at the end, there is a ask, how much money I need and how I'm going to use the money. And this is in this financial model, and we'll see the ask is exactly the cash flow that is missing in your management, your cash flow management, actually. So we will see an example right after showing you what do we have in a financial model. The first one is to have an assumptions page. Really important. Again, there are two things that are important in a financial model: the assumption page, where do you start, and how do you do it. It's not important to say I will have 10 million in 5 years time. Nobody knows what you're going to do in 5 years time. You don't know, the investor doesn't know, nobody knows. So doesn't matter if it's 10 or 5 million. What is important is how you get there. That's the most important thing. Where do you start and how you get there? So where do you start? Really, when the business already exists, like for few years, few months, maybe 1 year, 2 years, 3 years, you start with what you are doing today. If you are generating 1 million revenue, you cannot start by saying at year 0 I will do 10 million, right? 1 million, 10 million, it's really the difference is big. So you start with saying, today I'm doing 1 million, so I will start with 1 million, or maybe 1 million too, because I think by the end of the year I will do a bit more, right? And then from that million, you say, for the next year, this is what I'm doing, what I'm going to do. The three next years, these are the numbers I'm going to do. But really, you start with what you are doing today. If the business is new and doesn't have a lot of traction, you have to do some research, market research, saying how I'm going to start the first year. If I start today, how much I'm going to make the first year. So there you assess your market, you take your products. So it's a bit theoretical, but you take your product, the price, the pricing, and then the quantity you think you really you think you will address that first year, maybe 2% of the market, maybe 0.5% of the market, and then you get your assumptions. So really important to have clear, understandable assumptions. It's really key because people will be looking at those assumptions. So once you have those assumptions, you have four fundamental components of a financial model. You have the profit and loss, so income statement, profitability. There we'll see the profitability. Again, profitability doesn't mean you will succeed, because I will show you, if you don't have cash, and even if the business is profitable, you can get bankrupt. So profitability of the business. The balance sheet, that's where we'll see the investments, the financial requirement, etc. The cash flow statement, that's where you manage your cash. And the returns, the investor want to see if he'll get returns from everything you have said and everything you are doing, right? Really important. That's I will show you. One important thing is, for the first year, at least try to build your financial forecast month by month for the first year. Why? Because it's important to see if there is seasonality in your business. If you are, for example, in the tourism sector, we know that tourism is seasonal, is a seasonal business. In some countries, the summer you have more tourists, and the winter you have less tourists. Okay, so this have to be, we need to see if you have it in your financial model. If you don't have it, it shows that maybe you don't know very well your business and your industry, so you might lose interest from these investors. So it's really important to show the first year at least how every month you will be doing. And but for the other years, the second year, the third year, you can have it quarterly if you want, but you can have also in terms of years. Once you have done your assumptions, etc., now you start with your cost. People say you can start with your revenue, etc. Honestly, to be pragmatic, you start with your cost, because the costs are really easy to plan. I mean, costs are really easy to forecast, because you know exactly what would be your cost of sales, your marketing, your engineering, your admin staff, the salaries, etc. All these things, you can know them. I mean, you just call someone that you know in the industry. If you don't have already started, you call them, and they, know how much people are getting paid. This, you know, it's really easy to know. The investments, you know how much do you need to start your business, right? If you want to produce a product, you know how much it will cost you to produce it. And from that cost of production, then you can fix your price, right? But at least the cost of production. So this is really easy, and we at least I recommend people to start with this. Really easy. Now, once you have the cost, the revenues are a bit more difficult to predict. It's really important to do research, even if your business is already, you are running for like 2 to 3 years. It's important to do research, because you are doing some forecast. You don't know what is going to happen in the future, but saying I will do 10 million, you have to back it. You have to say why you'll be doing 10 million, because you are going to do, for example, you're going to go in 2-3 countries. Each of these countries, you have assessed the market, you have assessed the power of purchase for your products. You know that if you set your price at this level, people can buy it. You are targeting these customers, so you have a clear customer segmentation, etc., etc. So you have a lot of work to do here to make sure that the revenues you are saying you will be doing are accurate. Again, it's not about saying I will do 5 million and the investor will say, okay, you will be doing 5 million in 3 years. If you don't do 5 million, oh, you said 3 years ago that you will be no, this is not how it is happening. But when you say I will do 5 million, what is important here for the investor is to see how you're going to get your 5 million, if it makes sense or not. If it makes sense, he knows that you might do less, you might do more, but what is important is the way you're going to get there. Again, that's what I was saying. You have to break down the first year into 12 months to be able to see if there are seasonalities, etc., etc. So I will let you read the text here, but really important. It's the most difficult thing once when you do the financial forecast. I have showed you this example last time, how Airbnb did the revenue forecast. They started with the market, and then here they say we have a 84 million addressable market, meaning these guys are the guys we will be targeting, and then we can estimate that our revenue can go up to 2.1 billion, because if we have all these 84 people on an average fee of $25, we'll have 2.1. Of course, when they won't get this 84 at the first year, no, but they can say if we get 10% of this, it's good, and then we can increase by 15% every year, etc. And but what is important is we see the potential, and then you start with something today, and then how you will get maybe 60%, 50% of this potential. Really important. And here we see the link with the market and the revenues. Really, really important. So once you have done, you have this summary, this type of things where you have the products here, the gross revenue, net revenue, you have the expenditure, expenses, marketing, office costs, etc. We have here quarterly for the first year, for example, and then for the other 5 years, we have it in yearly basis. And then you see the result here. So meaning the first year I'm losing money, moins 52. The second year I'm losing money, but a bit less. And then I start making money on the third year. This is what we are expecting from a financial model, seeing how the business is growing. Okay, usually the first year you lose money, the second year maybe yes, the third year sometimes you lose money, but we have to see a trajectory of increase of growth in terms of revenue, how you manage your costs, etc. In the financial model, you have a detailed one, like I showed you in the management accounts. For each item, you have one. I will show you. But when you are presenting this in your business plan or in your teaser, it has to be summarized. We don't need to see all the details. If we are interested, we will see the details later. But for now, just summarize it. So here you have the revenue, and here you have expenses. And then the cash flow statement. The cash flow statement, the same thing that the revenue and so on, but here everything is automatically calculated because you have formulas that will calculate everything. I will show you exactly how it is done in a minute. But this is important to have, and here the sum of these two numbers, 5.2, is the ask. 520,000 US dollar and 172. The sum will be the ask. This is how we see how much do you need. We see you need, for the first year you need 500,000 US dollar. The second year you need 172,000. And this is when you go see an investor, you see I need let's say 700,000. When he see this, he say, okay, I know why you need 700,000. This is why a financial model is very important. Everything you are saying should be there, and then investor will say it. Then you know, here it's it's a summary of an income statement and the returns. So I really wanted to do it really easy and really simple to show you how we'll get those returns. So if we take the turnover, so we have this turnover here for the next 5 years, the expenses here for the next 5 years, the depreciation, sorry, for the 5 years, and then we have the EBIT, expenses before interest and tax, and taxes. We have the taxes here, 33, and then we have the profit. The profit is not the money because depreciation is not money. Okay, so here when you want to have the free cash flows, so you take the profits and you add the depreciation, and now this is the money you're really making every year. So every year, the first year you will be doing 46, the second year you will be doing 56, etc. And the fifth year you'll be doing 84. You have spent or invest 200 to start your business. So what are we looking for? We are looking, if I am an investor, equity investor, often, for example, financial professional investors, venture capitalists, etc. They have like a timeline to get back their returns. They say we cannot we cannot leave our money there for more than 5 years. So in 5 years' time, we have to exit. We have to get back out. If in your financial model, he will get back his money after 5 years, 1 year, 6 to 7 years, it means he won't invest because it's too too long for him. And also the internal rate of return. This is a kind of roughly, I usually say it's a kind of interest rate. It's not an interest rate, but it's the kind of interest rate for an investor to see if I am profitable, if the investment is profitable or not. If this percentage is low, they won't invest. Usually in Africa, people are targeting, depending on the country, depending on the project, of course, depending on a lot of things, but usually people target rates from 15% to 25%. If you have a business that is there, it's a good one. If you have a business that this rate is below 10%, usually it's not a good one. Okay, so people won't invest. So these are few returns people see. So how I'm going to see if I have a good payback period? You see here, I discount the future cash flow today. So if I discount by 5%, 5% is quite small. In Africa, in many countries, the risk is very high. So meaning people can use 10%, 15%, sometimes even more sometimes, to discount the cash flows. But if I discount this cash flow here, I have this number. So what I will be doing, really simple, I will start adding up numbers. So 200 plus 44, I still have a negative number. Second year plus 50, I still have a negative number. Third year plus 56, I still have minus 48. The fourth year, that's where I start having a positive number, meaning my payback period is 4 years. So if I invest today 200, I won't get back my money before 4 years. So if my timeline to get back my money is 3 years, it means this business, I won't invest in this business. This is really important. And at the end, I have the net present value. The net present value is the sum of all of this. I see I have 78.92. This is the money I'll be making if I discount everything. And then the rate is 66, almost 70%. These things, Excel generate them automatically because there are formulas that help you to do it. So what if once I have this is if I come back here, this is what I plan to have, right? what will happen. Most likely, meaning I will do same that the competition a bit. They will grow by 15%. I will be growing by 15%. That's my forecast how it is going to be. So before we do the quiz, I would like to show you an example of financial model quickly. So you can let me, yes. So let me a bit zoom. So this is just an example. You have a lot of examples, different financial model. Each business has its own financial model. But this is, for example, the summary where I have the summary of the business. So here you see the cash flow, how they are growing. Here the product, the price for the first product, the cost, and the number of the quantity I'm going to sell, the number of items. Here, if I have donations, grants, this is a really easy one, a really simple one, just to show you how it works. And then here I have some general assumptions. Okay. The products. So here I'm selling solar kits, right? So I'm buying raw materials. There is a labor cost, shipping cost, and import tax cost, and then I put them here. So in total, this product cost me $100. Okay, I need 60 days. This is the working capital, the day receivables. I need and the payables, meaning I need 30 days to pay these suppliers, and 60 days for people to pay me. So there is a difference of at least for these three first, there is a difference of 30 days, meaning 1 month. Okay. For the cost, same. I do my assumptions. So I have the salaries here for each. For the 5 next years, I set up. So I simplified everything. There is no increase in salaries. All the overhead costs. So marketing, office admin, payroll, etc. Telephone, legal fees, etc. I put everything here for the next 5 years. The investments, what I'm going to do. So I'm going to invest the first year here. I'm going to invest the second year here, etc., etc. So these are some basic assumptions on my my costs and my revenue. Here, I won't do everything. I will just show you later. But here you don't see any yellow cell, right? Because it all calculated automatically. For the P&L, P&L is the profit and loss account, or the cash flow. The income statement. Here you have the cash flow statement. Again, everything is automatically calculated here. The balance sheet and the use of funds. Here I have the use of funds and the source of funds. So let me just show you something. So here, you see what I was talking about. I have the financial returns in terms of internal rate of return. I have the funding gap, how much I need. So I add 10% of margin safety, and then I have here the total, the valuation of the company, the net present value I was talking about, and the payback period. So here I need 5 years to get my money back. So let me just show you something. If I want to test my model, and that's really what investors will be doing. Let's say I increase my raw material price by 10%. Again, just look at here, 58%, 58, 5 years, the net present value is 600,000. If I increase by 10%, you see the net present value decreased almost by half. I had 600,000, now I am at 300,000 here. So I need 6 years more, so more year, and my internal rate decrease. Meaning, even if I increase by 10% the price of acquiring my raw material, I reduce my profitability by half. It's just impactful. So I will make sure that I won't have an increase for the next years of 10% in my raw material, because if I have that, I will need to increase my price to have it. So if my price, I cannot increase them, it means I'm a bit stuck there. So this is how we use a financial model. So let's say I don't do that, and then I increase my selling price. Okay, for different reason, I say, okay, I can increase my selling price by 5%. Here I increase drastically my internal rate of return from 600,000. I go to almost 800,000, 850, right? Now I still have 5 years period, but I think it's much better. And then you see things are changing here. My returns are really changing just by changing field stuff. This is how we use, that's what we say, testing the model and stressing the model. The what if, actually I'm doing the what if I change some factors, what is going to happen? I'm going to be bankrupt, for example. Let's have here 0. I increase, I don't know, let's say I have salaries, people are asking me a lot of salaries, I increase by 10% the salaries. If I increase by 10%, you see there is some impact, but actually not much. Meaning, if people ask me to increase the salaries, maybe 10% is a bit too much. Let's say 5%. 5%, you see, the impact is not that important. So maybe I have a margin of increasing salaries if people ask me, my salary, if my employees, if they ask me to increase the salary for many reasons, I can say, okay, I can increase up to 5, up to 3, up to 7. And if I do it, I know how much revenues, how much profitable, how profitable I'll be. So I can really manage my business. So this is roughly, quickly, what we call a financial model. And again, you can download some examples and some templates on internet. Um, each business For each business, there is a specific financial model. That's why it is a bit difficult to have some generic templates, but you have some generic templates you can use, you can adapt. But if the business start being a bit complex and a bit specific, that's where it start getting difficult. But anyway, for investors, usually they build their own. If you send them a business to assess, they will build, the analysts will build their own financial models. So I will stop sharing the financial model and come back in the financial in the presentation. So we will do a quick quiz to finish. We are at the end of the presentation. So Jenny, can you just help me to have the second quiz?
Yes,
Right.
you should see it now.
Yes, I'm seeing it. So please, just to answer quickly on these, you have multiple choices. What are the main objectives of a financial model? I talked about it. Yes, okay, all of them. For the first one that replied, it's not all of them. Just to say, it's not all of them. Not all of them, guys. I'm helping you. Mm, well, okay. Well, here, uh, actually, I will come back on the slide to show you why. But we have, okay, you have many reasons to create a financial model. But what I've showed, we have 4 ones, only 4. But you can have others, but these 4 are the key ones. And on this 4, you have to show the first one, show investors how you plan to make money, right? Thank you, Jenny, for the pool. The second one is also good. Translate your business into numbers. Cash planning is important. It's part of it. The what if is also part of it. The management account is not part of it. Building the objectives to build your financial model. No, management accounts can help you to build it, because when you have management accounts, you have some forecast for the next year. You have the assumptions you can build already, because you know exactly how much you are doing today. So actually, the management accounts will help you to build an accurate financial model, at least for the assumptions and the first year forecast. But they are not an objective. They are not part of the objectives. Okay, so they will help you, but they are not part of the objectives. So quickly, I will come back on the reasons of building. So you see, these are the four things: investors, how you make money; translate your business ideas into numbers; the what if question; and how you plan to how you do your cash planning. So that is it for this presentation. But just I wanted to finish this three weeks presentation by showing you an example of an investment readiness program. It's an example. One of the program we have designed. Um, we have 3 or 4 others, one depending on the level of the business, depending on the context. But this is one of them we have developed. But you will have it on the slides, and you will have it on the slides, so you can read them carefully. But just to highlight the main components, the first one is what is investment readiness. So we will show businesses what they need to be investment ready, and then we'll assess a bit. We'll assess them before, so we'll send them a company profile. For example, they will a one page, actually it's a one page profile where they will put some information, and then we'll assess with them their ecosystem, etc. So this is really important to know, to know who they are planning, and with who they are, where they are planning, and with who they are playing. And then understanding equity investment. So we'll go through what are the main equity investors, how they work, what are their requirements, for which business they will be more sensitive. For example, the business angels will be more for early stage businesses. If you are a mature business, big one, usually you won't go for equity for business angels, but you will go for venture capitals or private equity funds, for example. We show also the investment process, how it is going to be. So it's very important for them to understand who they will be interacted and how. And then we assess their own business, each of their business. We assess them. So we have a investment readiness checklist. What we will be expecting from them. So they will feel it's a kind of form they will fill and say where they are there. So you can assess if they are quite ready or not yet, or and then you will see where they need to improve. And then we'll assess the main component. We have talked about them: the value proposition, market size, adoption, pricing strategy, products, what they are selling actually, the value architecture, so the go-to-market, operational strategy, marketing strategies, and what we call the profit equation. Profit equation are mainly financial statements, revenues minus cost. Are you making money or not? And then we have also some financial metrics and some other metrics to assess the business. And that's where also we'll have assessing this will help us to build some documents. For example, the management accounts we just talked about. So we'll have everything in there, and also we will have a finance manual. The finance manual will help the business to see who is doing what. For example, if the CEO if we have a team and the CEO is managing all the money, this is not good. For example, if I see this, I say, well, we have to separate the powers. The CEO will manage the business, but someone else will manage the money, to make sure that it is well managed. We'll assess the team. Why this team? And assessing the team is also assessing the board. If there is a board, the board of directors that is helping the business. the investment appraisal or the investment proposition part of it. Let's say the investment proposal appraisal will be the financial projections, financial modeling, and the valuation. What is the valuation of the company? How you can do the valuation of the company? The legal aspect of being investment ready. Your company, is it ready? Do we need to change something in your company? Also understanding these investment documents, term sheets, for example, shareholder agreements, convertible notes, all these things. So important for them to understand and to make sure that legally they are ready. And then we'll finish with the pitch deck, which is the summary of all of these things. So you know what is investment readiness is. Where do you stand? Are you ready or not yet? If you are not ready, how in which area you need to improve to be much more ready? There is no black and white answer in investment readiness. Depending on your business, people will assess, but at least you have to have a certain level of readiness to be accepted, to to be interested for many investors. So you will have this program in the slides. I mean, you can build your own, but this is just an example that I really wanted to share with you. So that is it. Thank you very much. I hope you enjoy it, and if you have any question, I'm here. So maybe if the ITC team is around, kindly share. Yeah.
So here in the chat, we have two similar comments from Patrick Zambia and Bright Choi, asking to share the templates because it will help practice as we try other models and templates. So Adrame, I think you mentioned that those templates you had to pay for, right? But
Yes.
maybe you could also share some links of some free options.
Yes. Actually, what I will be doing, all the templates I have used, I will send them. Let's say there is the financial model template. I will send it to you. Okay. The management account template I have used, I will send you the link. Yeah, you can download it, you can use it, but unfortunately you will not be able to change the formula because they locked the formulas. If you want to change them, I think you have to buy them, or yeah. For the one that is asking, are you going to show us how to use the Excel or create this formula, or are you going to share some of these templates? Yes, I'm going to share the templates. Actually, the formulas depend. It depends. It's really difficult to design or to share some formulas in these Excel files. Why? Because sometimes, depending on where you are, for example, the management accounts, and when you are building your income statements, your balance sheet, depending on the country where you are, it can be slightly different. Okay, so it's really important to understand how in your country, for example, the taxes are generated, how, or you have what is the rate of paying taxes. There are some items, for example, it's not the same name, etc., etc. Even if in general, globally, you have the same template for all businesses, but for some specific businesses, for example, here we took the template example of a business that is selling juice, right? Juice product. So if you are a software company, for example, of course it will be different. You won't have the same items, but usually the formulas to generate an income statement or the cash flow statement are the same. That's why they are locked, and then you cannot really change them. But building those things are quite easy. If you have some, I will be glad to give you feedbacks on it. But unfortunately, we won't be able to build each for each of you a template, or and even, you know, for your businesses, if you want to help them, you won't be able to build for each of them one. You can have a generic one, they might start a simple one they will use, and for some of your businesses that really want to to to, to complexify them, to adapt them to their business, they will do it by their own. But yes, I will share the templates. Could be used in different investment choices, venture capitals or angel investors. Yes, well, Babukar, access to video. Yes, sorry, it's a bit technical. Yeah, and that's why I was saying today will be a bit technical. But really, what is important for you guys is to understand these products, why we use them, these tools, why we need them. Really important, why we need them, and how we are going to use them. But to create them, you can get some help from I mean, you can download some templates. You have always templates to download on internet. Honestly, I can share. I will add some links on the presentation that you can go and see. You can, even if you won't be able to use them as they are, at least they can inspire you to create your own. Okay. Uh, can you use these templates in different investment choices, venture capitalists or angel investors? Yes, they all need these things. Again, these tools are first for your business. First for your business. They are not for any investor of any bank or any other financial institution. First, it's for the business. The business need to create this to monitor its activities, to do the right forecast, etc. So doesn't matter with who you will be talking with, you need to create these things, these tools, these templates. Once you have those templates, now, depending on who you are talking with, you will be sharing with them a certain level of information. Maybe at the first chat, the first meeting, you won't share your management accounts. No, of course, it's too sensitive, and the investor is not showing yet any interest. So first, you write a nice teaser, a nice pitch deck, and you share with them, and then you start talking. If you see that there is an interest, they really want to go a bit deeper in your in the company, in the activities, that's where you start sharing some of these informations. And even maybe you won't share all of them. You start by sharing, for example, uh, maybe for the management accounts, for example, you can start by sharing the reports, because these management accounts, once you have them, this is the tool you'll be using. But you will, out of this tool, you will generate a report. For example, you will take some tabs on the Excel to generate the reports. So every 3 months, for example, you can generate your income statement. It's not the official ones, but you can generate one. This you can share maybe with your investors. So they won't see all the details, but at least they will see how good you are doing. And then if they confirm their interest, they offer a term sheet during the due diligence, for example, that's where they will see all the details, because they need to see the details if you are not mistaken in somewhere, in somehow. And then yes, but to answer to the question, yes, you can share this with any type of investor. Some of them, if they ask you something you don't have, don't worry, they will do it by their own. And yes, and again, these are 3 tools I have shared with you. Tools, meaning these are things you can use with everyone, but they are not the only tools. This is to attract investors' interest. But once they are interested and they are doing their due diligence, you will need to show much more than this. Much more than this means you will share with them some reporting you have put in place, right? If you haven't done, they will help you to do. Maybe you will need to share the finance manual if you don't have one. When I say you, I'm talking about the company, of course. The finance manual, maybe the HR manual. If you have some board meetings, maybe some board reporting, for example, These are things they really want to know. If you are renting your office, maybe they will ask you the contract of this rent to make sure that you have an office. If you have some assets, maybe they'll ask you these assets, the contract, when you bought those assets. If you have some intellectual property, they will ask you the license, etc., etc. So these are things you have in your business or in the business you are helping that you don't need to show at the beginning. The tools I'm showing you are more tools to make sure that the investor understand fully your business. Once they understand it, they say, okay, I want to invest or I don't want to invest. If they say, I want to invest, they will issue the term sheet. And when they issue the term sheet, now they will do due diligence. And then during the due diligence phase, they will go a bit deeper. So everything you have said here, for example, your sales, if you say, I generated 3 million sales this month, they will go and check, right? They will see your invoices, they will go and check your accounting, etc. They will really check everything you have said here in the financial model, in the teaser, everything. Okay, so these are basic templates to attract their interest, but make sure that the businesses have all the other requirements, the reportings in place, etc. I think that's all the questions. And of course, guys, you have my contact details. If you have questions, I can answer those questions. Yeah, and I'll be glad to keep in touch. We are doing stuff in different countries, so yeah. So right now, I think nobody is traveling, but for sure, if you have any questions on all the things we have seen, we have talked about in these 3 last sessions, I'll be available to answer to them. Thank you very much.
Thank you, Adrame. Thanks everyone for staying with us through this 3-part workshop. And we look forward to see you again in the next topics that we're going to be covering in this session, in this series actually. So the next session is on partnerships, where we will be talking about the importance of working with partners to leverage expertise, finance, among other issues. So we will have a team of experts sharing some insights, how they have done it themselves as hub managers or as potential partners, how you could approach them. So if you want to know more about this session, we have posted the information in our LinkedIn group. In case you are not part of the LinkedIn group just yet, maybe I'm going to ask Jenny or Nuria to post a link to the LinkedIn group in the chat box, which is a community that we have just created to keep the exchange among hubs from across the world. And finally, before you leave, if you could fill the survey that Nuria have posted the link in the chat box, that would also be really helpful for us. So in the future, if we are redoing this session again or doing something similar, we can learn from this and improve. Thank you again for joining us. Hope to see you next time. Bye-bye. Have a good day.
Thank you. Bye-bye.
Thank you.